Most people think child benefit is simple. You have a child, you claim it. It arrives every 4 weeks. And unless you are clearly a high earner, you carry on receiving it without thinking much about it. That assumption is the reason thousands of families across the United Kingdom are sitting on a tax charge they do not know is building, and why some families who stopped claiming child benefit years ago to avoid the charge are still missing out on something more valuable than the payment itself. Welcome back to HMRC Update. Today, I want to go through the child benefit changes that landed in 2026, the ones that affect how the charge is collected, the payment rates that changed in April, the new PAYE option that removes the need for a self-assessment return for many families, and the situation that catches more people out than any other in this area, the one where stopping child benefit to avoid the charge turns out to have been the wrong decision, not because the charge was avoidable, but because stopping the claim costs something that cannot be paid back. If you are not subscribed to HMRC Update, please do that now and hit the bell. Child benefit is one of the most misunderstood areas of the entire UK tax system right now, and the changes in 2026 have added new layers to that confusion. Subscribe. Let us get into it. From the 6th of April 2026, child benefit rates increased. The weekly rate for the eldest or only child rose from £26.05 to £27.05. For each additional child, the rate increased from £17.25 to £17.90. The annual value of child benefit for a single child is now £1,406.60. This increase is automatic for existing claimants. No new application is required and no action is needed to receive the higher rate. It applies from the start of the 2026 to 2027 tax year. That is the straightforward part. Here is where it becomes more complicated. The high-income child benefit charge rules have not changed alongside the rate increase. For 2026 to 2027, charge applies if the highest earner in the household has an adjusted net income above £60,000. The charge is calculated at 1% of the child benefit received for every £200 of income above £60,000. Once adjusted net income reaches £80,000, the charge equals 100% of the child benefit received, effectively canceling out the financial gain entirely. The combination of those two facts creates a specific situation that is easy to miss. Child benefit went up, the charge threshold stayed the same. That means families where the highest earner is between £60,000 and £80,000 are now receiving slightly more in child benefit payments, but also facing a slightly higher charge on that larger amount at tax year end. The net position has not changed dramatically, but families in that income band who have been estimating their charge based on last year's figures will find the number is slightly different this year. The high-income child benefit charge is collected by HMRC through self-assessment. Individuals who are liable to pay it are required to file an annual tax return if they do not already do so. That requirement, filing a self-assessment return purely because of the child benefit charge, has been one of the most significant sources of frustration for families caught by the charge who have no other reason to interact with HMRC's self-assessment system. HMRC has now changed that, and this is the most practically significant update of 2026 for families in the charge zone. HMRC has introduced a new option for paying the high-income child benefit charge through the PAYE tax code, rather than only through self-assessment. Parents can now choose to have HMRC automatically adjust their tax code to collect the charge throughout the year. Those who choose this route will no longer need to file a self-assessment return just for the high-income child benefit charge, provided all their other income is taxed under PAYE. What that means in practice is this. If you are employed, all your income comes through PAY, and your only reason for filing a self-assessment return has been the child benefit charge, you can now opt out of self-assessment for this purpose entirely. HMRC adjusts your tax code. The charge is collected gradually through your monthly payslip across the tax year, instead of arriving as a single lump sum payment in January. The total amount collected is the same. The method and timing are different, and the annual self-assessment return, with all the administration, deadlines, and penalty exposure that comes with it, is no longer required. You can sign up to this system if you have no other reason for sending a tax return and you are paid through the PAY system. Those earning between £60,000 and £80,000 will receive correspondence from HMRC explaining how to use the new system. If you are in this income band and have been filing a self-assessment return solely for the charge, watch for correspondence from HMRC about switching to the PAY collection route. If you have not received anything and want to move to the new system, contact HMRC on 0300 200 3100 to ask how to register. If you have other sources of untaxed income, rental income, significant savings interest, self-employment earnings, you will still need to file a self-assessment return regardless of this change. The PAY option applies specifically to people whose only self-assessment obligation was the child benefit charge. Drop a comment below if you have been filing a self-assessment return purely because of the child benefit charge and did not know this new option existed. I want to understand how many families watching this channel this change directly helps. Back to the situation that catches more people out than any other. Here is the thing that surprises almost every family I explain it to. Many parents decided when the high-income child benefit charge was introduced, or when their income crossed the £60,000 threshold, to simply opt out of child benefit altogether. The logic seemed sound. If the charge is going to claw back what you receive anyway, why claim it at all? Why go through the administration of receiving the payment and then repaying most or all of it through self-assessment? The simplest solution, the one that feels most logical, is to not claim in the first place. That decision for many families was a serious financial mistake. Not because the charge could have been avoided in some other way, but because opting out of child benefit does not just stop the payments, it stops the national insurance credits that come with it. For many families, the national insurance credits attached to child benefit represent a more significant long-term financial benefit than the payments themselves. When a parent, typically the one who is not working or who is earning below the lower earnings limit, claims child benefit for a child under 12, they receive national insurance credits automatically for each week of that claim. Those credits count as qualifying years toward the state pension. One qualifying year adds approximately £6.89 per week to the state pension for life. On a 20-year retirement, one qualifying year is worth over £7,000. A parent who stayed out of the workforce for 6 years while raising children and claimed child benefit throughout receives 6 years of national insurance credits, potentially adding over £40,000 to their lifetime state pension income. A parent who opted out of child benefit to avoid the charge receives none of those credits. The years they spent raising children generate no national insurance record. The gap shows up in their state pension forecast as qualifying years missing, and unless those gaps are filled later through voluntary contributions at a cost of approximately £907 per qualifying year, they permanently reduce the state pension. The correct approach for families where one partner earns above £80,000 and the charge would equal 100% of benefit received is not to opt out of child benefit entirely. It is to claim child benefit and ensure it is registered in the name of the non-earning or lower earning partner so that that partner accumulates the national insurance credits and then for the higher earner to repay the charge through self-assessment or from 2026 onwards through the PAYE tax code adjustment. The net cash position is the same as not claiming. The national insurance credit position is entirely different. If you opted out of child benefit in previous years and your non-working or lower-earning partner has gaps in their national insurance record as a result, it is not too late to correct the situation going forward. Re-registering for child benefit now, if you still have a qualifying child under 16 or under 20 in approved education or training, restores the credit going forward from the point of registration. Gaps already accumulated cannot be filled retroactively through child benefit credits, but voluntary Class 3 national insurance contributions at approximately $907 per year can address gaps from the last 6 tax years. Before paying any voluntary contributions, always call the Future Pension Center on 0800-731-0175 to confirm that filling a specific gap will increase the eventual state pension. In some cases, the calculation means it will not, and that call prevents money being spent on a contribution that changes nothing. There is one more piece of the child benefit picture for 2026 that is catching families out, and it relates specifically to reporting obligations. From January 2026, HMRC placed greater emphasis on accurate and timely reporting of changes in circumstances. Parents are expected to notify HMRC promptly when circumstances change. Unreported changes can result in overpayments that HMRC later recovers. The January 2026 reforms aim to significantly reduce these situations. The changes in circumstances that must be reported to HMRC for child benefit. Purposes include a child turning 16 and leaving approved education or training, a child going into local authority care, a change of address, a change in the income of the highest earner that moves them above or below the £60,000 threshold, and a change in who is responsible for the child, for example, if a couple separates and the child moves to live with the other parent. HMRC systems are now receiving real-time data from employers and PAYE records. A family where the highest earner's salary rises above £60,000 mid-year due to a promotion or a bonus is increasingly likely to be identified through payroll data before the end of the tax year. If that family is not registered to pay the charge, either through self-assessment or through the new PAYE option, HMRC may contact them directly with a demand for the charge for the completed year, including any period where the income threshold was already crossed. If your income has changed this year in a way that has moved you above or below the £60,000 threshold, the correct step is to contact HMRC on 0300 200 3100 to update your child benefit position. Moving above the threshold does not require you to stop claiming. It requires you to either register for self-assessment or register for the new PAYE collection route, so the charge is collected correctly rather than building as an unrecognized liability. So here is where the complete picture sits and what to do with it today. Child benefit rates increased from the 6th of April 2026. The rate for the eldest or only child is now £27.05 per week, £1,406.60 per year. For additional children, the rate is £17.90 per week. Existing claimants receive the increase automatically. The high-income child benefit charge thresholds have not changed. The charge applies above £60,000 of adjusted net income. At £80,000, the full benefit is clawed back entirely. The charge is 1% of child benefit received for every £200 of income above £60,000. From 2026, families where the highest earner is employed under PAYE and has no other self-assessment obligations can now choose to have the charge collected through their tax code rather than through a self-assessment return. Contact HMRC on 0300 200 3100 to ask about registering for this option. If you opted out of child benefit in previous years to avoid the charge, check the national insurance record of the partner who is out of work or earning below the lower earnings limit during that period. Gaps in that record reduce their state pension. Re-register for child benefit now if you have a qualifying child. Address historical gaps through voluntary Class 3 contributions after confirming with the Future Pension Center on 0800 731 0175 that filling them will increase the eventual pension. And if your income changed this year in a way that has moved you above or below the £60,000 threshold, notify HMRC promptly. The charge builds from the point the threshold is crossed, not from the point HMRC is told about it. Child benefit looks simple from the outside. Inside the rules, there is a layer that affects national insurance, a layer that affects self-assessment, a new option that removes that self-assessment requirement for many families, and a threshold situation that is generating both unexpected charges and avoidable pension gaps for families across the country. You now understand all of it. Share this with a parent or family member who receives child benefit or who stopped claiming it because of the charge. The information about national insurance credits alone could make a very real difference to someone's retirement income. Subscribe to HMRC Update if you are not already here.